The US yields pushed higher and the US dollar rally gained further momentum yesterday, as investors continued to surf on the idea that Donald Trump's pro-growth policies and tariffs would boost inflation in the US and limit the Federal Reserve's capacity to ease the monetary policy as much as previously anticipated. Yesterday's data showed an improved economic optimism in the US in November. Minneapolis Fed President Neil Kashkari said that he'll be looking at the inflation data to decide whether he would back another rate cut in December. And activity on Fed funds futures gives no more than 62% for another 25 BP in December, before the release of the latest CPI update today. The CPI data has regained importance since Donald Trump was re-elected president of the US. Jobs data remains crucial for the Fed's policy path, as the last thing the Fed wants is to panic and lose control of the situation. But the Fed's victory over inflation looks more vulnerable today than it did a month ago. And that's supportive of the US dollar. Of course, October figures won't tell much about the Trump effect on consumer prices. We must wait a few months before we start seeing the impact of Trump on numbers. But the higher the numbers, the lower the December cut expectations. And I sense that today's numbers may not soothe the doves' nerves. The US headline inflation is expected to have climbed from 2.4% to 2.6%, while core inflation is seen steady near 3%, still significantly above the Fed's 2% policy target. Any upside pressure in figures should continue to drive capital into the US dollar. But the US dollar has hit the overbought market conditions following a 6% rebound since the beginning of October. Therefore, any weakness in the data could help tame demand in the short run, trigger a minor correction and give the US dollar bulls opportunity to strengthen their bullish positions for the year-end. Voices calling for a further slide of EUR/USD toward parity are growing.